So let's go on to the next type of value that you can find in the stock market, and we call it based on our book that we wrote, Value Investing in Asia. We categorize it as current earnings power value. This type of company we're looking at is a company that has very consistent earning power. So they are what we call a money machine with quite a predictable future. We talk about the consumer staples company and matured company with stable growth, or just company, or even the real estate investment trust, some of them where they have very systematic and stable dividend coming out all the time, or like a telco or utility. These are companies that we can categorize as current earning power. So their earnings doesn't change much year to year. They are not in huge growth industries. Their free cash flow is very strong. So these are the business that we can consider under such a value. So for the example here, we have included this company called Carlsberg Brewery Malaysia. It's basically the listed subsidiary of Carlsberg, just its Malaysia and Singapore and Brunei business. So let's go through the 6 topic that we should look at to form the story again. What is its business? Its business is in the manufacturing and distribution of alcoholic beverages, mainly beers, and including the Carlsberg portfolio of brands. Okay, and where is this addressable market? Its addressable market is in Malaysia, Singapore, and Brunei, the 3 keys market. But interestingly, it also have a small stake in an associate brewery called Lion Brewery in Sri Lanka. So these are the 4 markets that it is in. So unless the company go out to invest in another associate company brewer in some other countries, that will mainly be the key market that it will be operating in. That's because it is, like we said, a listed subsidiary of Carlsberg AS. And Carlsberg AS, the parent company, has operation in almost every country in the world. So they're not going to use Carlsberg Brewery Malaysia to expand overseas. If they want to expand overseas, they will do it themselves on the parent level, right? So these are the things we have to consider. But having said that, what is its swap analysis? Okay, so the company is going to has a strong relationship with Carlsberg because it is a listed subsidiary. It has a strong opportunity to grow its brand portfolio. Currently, it's only have about maybe a dozen brands that it carries in Carlsberg Brewery Malaysia, but Carlsberg itself has more than 400 brands, right? So they can grow horizontally by adding new brands. And their strength is they have a strong distribution and marketing already in all its key market. It has been operating in these 3 markets for a long time, and they have a big presence in the market. And lastly, they kind of have a strong pricing power, okay? Because every time, say the government will try to increase the duties and excess on alcoholic drinks, straight away the next day Carlsberg will come up and say, are we going to raise prices? And most of the time, nothing happens, right? Everything just goes on as the same. It doesn't matter if they're charging it 1 big bottle for $10 or $11. People are still going to buy it. And so that's a key strength for the company. And in a way, it's because it mostly operate in what we call a duopoly market, where its key competitor, Heineken Malaysia, and Carlsberg Malaysia, they basically own the market. It's like Coca-Cola and Pepsi. Okay, so they have a very strong pricing power. And let's look at the weakness and threat. But because they're already so strong in the key market, if you flip it the other side, it also means there's lack of growth for the company. Okay, and they're highly dependent on regulation. Like we said, the government can and most probably will increase tax and duties on the products in the future as well. All right. The government tax and duty is already the main expenses for the company, and I think it will continue to be, and they are very highly dependent on what the government is going to do. And lastly, being a listed subsidiary, it is also dependent on the success of its parent, right? If Carlsberg AS has some problem on the parent level, it's quite hard to imagine that Carlsberg Brewery Malaysia will have a bright outlook, right? Unless it gets taken over by a competitor. Next, we look at the reinvestment risk of the company. Interestingly, being a brewer, the manufacturing process is quite simple. It's not very high tech, and they already have the factory and distribution network. So there's almost very minimum capex for the business at the moment, and they have been in this cycle for a long time. So we can be safe to say that the reinvestment characteristic is quite low, or even sometimes there's no capex at all for the business. And from all these 5 factors, we can conclude or form an opinion that the business risk of this business is quite low. It's really quite low. They are very stable, and in key markets where they have already been operating for a long time, and they're just a money machine, like we said, right? We will also look at how we value this company in the next video. But right now, you have to think about the advantage and disadvantage of this type of value. Okay, again, it's a very easy to use method of evaluating a company. We can simply do it by adjusting its earnings. It is fast to compute, and sometimes you can compare it with your competitor as well. It's not too hard, but there will be more assumption that we need for this kind of company, right? Because we are making assumption on how much the company can actually make. There's more assumptions to go into it, and it becomes more tricky if we are talking about some cyclical company or company that is turning around its business, right? We have to make assumption on how long does it take for the company to turn around its business. So we might miss out on the future growth opportunity, like if this company suddenly invest in, say, the Vietnamese brewery, which is growing extremely fast, does that change its characteristic? It might. And if we are just evaluating it based on its current earnings, then we might miss out on the growth opportunity. We might feel that, oh, this company is quite overvalued, but if we include the growth factor of its new investment and things like that, maybe it's not too overvalued. And it's very hard if we are going to use it on conglomerate where company has many different business segments, because some of them might suit into a current earning classification, but some of its business might not. So you can't really lump everything together and say that, oh, this is a current earning power type of company, but rather you have to zoom it in on the subsidiary level. And that's quite difficult if you're looking for conglomerate.